queries on the show today, and I think we should totally go ahead with those queries now because we'll be running on short of time. Shweta, Anil Avinash Singhal's question we'll take first. Okay, he's got a couple of mutual funds: SBI Contra, Access Small Cap, Kotak Emerging Equity, Parag Parikh Flexi Cap. Currently, he's doing an SIP of 1 lakh. He's an aggressive investor and want to invest for 10 years and would like to step it up also by 10% every year. I do not have him on the phone line, so I don't know what's the corpus he's looking at and the kind of recommendations he's taken from someone or whether it is his own research. We won't be having any idea. But then, as he rightly said or called himself as an aggressive investor, we can see that in his portfolio as well. But then, okay, he definitely needs some more stability. So, would you want to add a large cap to his portfolio?
Yes. So Avinash, I was, actually seeing your portfolio. Now you're doing an SIP of 1 lakh, but your mid and small cap fund put together 60% is getting invested in these two schemes, which means roughly the exposure that you have to the space is around 60%. I would say that is really aggressive. And it not necessarily means that high risk would yield you high returns, right? You need to maintain a balance between risk and return. So look at reducing your exposure to mid small. I think around a 40% odd exposure is good enough. And given the situation also right now, that's what I would suggest. What you can exit, I would say Access Small Cap and Parag Parikh Flexi Cap. These are two schemes you should exit from. Instead, what you can add for an Invesco India Small Cap Fund, a Canara Robeco Multi Cap Fund, and I'm suggesting you one more scheme to add, which is the HDFC Flexi Cap Fund. So if you split it this way, you'll go a little heavy towards large cap, which is what you need. Plus, your scheme level exposure could come down a little. So that's my recommendation to you.
Ah. All right. I think we have a caller on the phone line also. Hi, good evening.
Yeah, hi.
Hi, Kumar. You're calling from?
Yeah, I'm calling from Ranchi, Jharkhand.
All right. Okay, so you want to ask about NPS or tax benefit on NPS?
Yeah, so initially I was in old regime, right? So I was taking both corporate NPS plus personal NPS as well, 50,000 one, right? Now I'm
Right.
trying to opt out of tax regime, right? That old one and trying to go to a new tax regime, right? So will
Sure.
it be beneficial for me to still invest in NPS or should I opt for personal stock investment?
Okay. I just want to understand NPS as an investment option is actually, I mean, tax saving is a definitely hooked, a very nice hook to it, but it is also a retirement investment option. Do you have your portfolio aligned in that way, which is going to provide you for your retirement corpus?
I've not considered anything as of now in the NPS portal for
Okay.
retirement.
So that is the whole purpose behind having an investment strategy, Kumar. And a lot of time we also advise our investors. Uh, do you have tax saving options as per the old tax regime? Try and align them with your financial goals. NPS is a wonderful product if you align it to your retirement goal for your retirement purpose. The way I think you have taken it up for tax saving purpose, which is of great advantage or great benefit on this investment option that you get. But now since you are in the new tax regime, you can still invest in NPS and get an employer contribution benefit. Shweta will be able to explain this to you better. But as far as the whole intent of investing in NPS goes, it is for your retirement purpose. And be it NPS or be it regular mutual fund, you get tax benefit on it or you do not get any tax benefit on it. Just have the intent right. Shweta.
Absolutely. So Kumar, one, I also would want to understand, how much time do you have for retirement? Like Kavita was explaining that with the NPS, two benefits that you would have is definitely it helps you plan for your retirement. Second is the tax advantage that you get. Now, that 50,000 additional that you were doing was giving you that extra tax advantage, which if you shift to the new tax regime, you don't really need it. But the collateral benefit that you were getting for your retirement planning is, you will need to plan for that if you're not doing an NPS. You can continue to do NPS from a retirement planning standpoint, Alternatively, I'm giving you an alternative now because when you do an NPS till the age of 60, your money is blocked. Even after that, a portion of it is what you will get lump sum. A portion you will get it as accrual that you would keep getting every year. If you want more flexibility in terms of how much outflows do you want, how much withdrawal you would want to do every year, the money that you were doing in NPS, instead you should follow an asset allocation for that. uh, I'm not too sure of the kind of investment horizon you have. Do you have 5 years, 10 years, 15 years to your retirement? If you have a longer tenor, we've seen, 70 to 80% equity also works, and the balance in debt works for you. It'll help you compound and grow your money at rate of returns, which would be very similar to what, NPS rate of returns could be for you, but with the flexibility of having withdrawals of your choice and at frequencies of your choice. So that's an alternative solution for you to plan your retirement. And you don't have to worry about the tax incentive any which ways because you're in the new regime.
All right, a lot of investors, Shweta, looking at the volatility in the market, are moving. They want to opt for maybe insurance and investment linked products. They want to opt for NPS. Direct equity plans are they don't find it very attractive looking at the volatility. Do you think it's the right time to have these kind of products in the portfolio as well, because they think that this might just give them insurance coverage of insurance, and also a part of investment can go into it, although in a long term perspective, and looking at the kind of benefit over inflation that equity has given, one might not want to take this kind of a strategy, especially products where you get a mix of insurance and investment. But the fear component really plays on you, okay? And which is why someone who had just tried their hands in equity definitely are not aware of what the volatility of the market. They are they get very jittery looking at this particular movement, and which is why they again fall back on the traditional way of investments, which could also be an insurance come investment product in insurance, or something like an NPS, where a longer lock-in troubles them, but at least they have that peace of mind. What will you say?
Kavita, you're right that what happens is most often than not, we look at our investments more from a product standpoint rather than a portfolio. What I'm trying to say here is that, see, you have this option of this 1 lakh, you either putting in an insurance plus investment kind of a product, or you may call it as a ULIP, or an NPS where the money was getting blocked for you. You don't have control over it. You cannot withdraw it. And it's a combination. So, it's providing you some kind of, better performance or lower volatility as compared to pure equity. But instead of doing that, that same 1 lakh, if let's say you're following an asset allocation for it, and this is the key. Let's say you're investing 70 in equity, 30 in, when the markets are correcting, don't only look at the performance of that 70%. See that entire 100, how has it performed? So if in this situation, let's say last year, or from the fall, the markets have fallen by 10% in the last 6 months, and your portfolio, because you had that equity debt combination, and within equity, you had some active management playing for you, is, still maybe just down by 9% or has barely met the market performance, then you have to have a holistic picture in your mind and look at it in its entirety. That will help you remain calm and continue with your strategy, which will benefit you in the long term. So I'm just repeating, don't go product specific, but look at your entire portfolio as a whole and see how it's performed. And if you keep doing this, if you keep reminding yourself, these, being 100% investments of equity plus debt, and this approach would work better than a lot of these traditional products of ULIPs, and sometimes which also come in at higher cost. They'll lock in your liquidity for an extended period. They'll work far better for you.
All right, very important point to note that you should not be having a product-based strategy, have a portfolio-based strategy. Let's move on to Sanjeet's question. And he wants to deploy some cash in mutual funds and would love your expert opinion on this. He is looking to invest 1.5 lakh initially and then start an SIP of 20,000 per month for 5 years. He shortlisted few funds for himself: ICICI Blue Chip, Nippon Small Cap, Edelweiss Mid Cap, Parag Parikh Flexi Cap, Edelweiss Greater China. And he wants to understand if the purpose of diversification is really solved as per this selection. And yeah, for 5 years period, what will be your recommendation if not these funds?
Sure. Sanjeev, I would say you've tried to diversify it as much as you can from a market cap allocation standpoint, from an AMC exposure standpoint. Just a few suggestions from my end. I would say looking at the current, global scenario and way the different economies could get impacted, I think India per se is far better placed compared to a lot of the global peers. So having your allocation 100% Indian equities may work the best for you at this point of time, even if I'm looking at it the next 3-5 years. So I wouldn't recommend an Edelweiss Greater China fund for you. The other fund where I would say you must, you should ideally reconsider your allocation would be an Edelweiss Mid Cap and a Nippon Small Cap fund. Instead, what you can add on to your portfolio, you can consider a Kotak Emerging, an HDFC Small Cap, as well as a DSP Equity Opportunities Fund. So you can start with these, 4-5 funds in your portfolio. Keep reviewing them once every year. So I'm shifting you to 100% Indian equity, but spreading out across a large and small exposure for you.
And definitely, geographies like China might not be the a right time to put your money in. In fact, diversifying internationally, if it's good if one can just hold on for a few more months. Let's take Anantha's question. And he says that he is 32 years old. SBI Focus Fund 2000 SIP, Tata Small Cap 2000, Parag Parikh Flexi Cap 2000. 20 years time horizon. I don't know the corpus that he wants to accumulate.
You have a very long-term horizon, and if you just continue with 6,000 SIP, this will get you to somewhere around 60 lakhs. That's the rough math that I had done. I hope that will help you achieve your objective. If not, consider doing and step up to your SIP 5%, 10%, whatever you can. Now, since you're just starting off your portfolio, I would suggest another basket of funds altogether for you to invest in. Try and stagger it. Try and have 4 schemes at least in your portfolio. So 1.5 thousand in every scheme. Diversification schemes that I suggest is you go in for a Kotak multi cap, an ICICI dividend yield fund, one Invesco small cap, and an SBI large and mid cap fund. So I'm trying to get you a mid cap exposure through other categories and have a small cap fund because you have a 20-year horizon, plus reduce scheme level exposure. So this is what you can start with. As you go on increasing your SIP, you can go on adding one or two more schemes to the portfolio.
All right, with that, it will be a wrap on the show. Thank you so much, Shweta, for taking time out and answering our viewers' portfolio queries today. Thank you so much. And for our viewers, I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.